What is up, everybody, and welcome back to my YouTube channel. And before I can get started with this video, I just want to do a quick recap of the past 3 episodes. So in the first episode, I introduced market structure. I demonstrated how to map out market structure, and then in the second video I introduced substructure. Then in the third video I introduced to you liquidity, and in today's video I am introducing fair value gaps, also known as imbalances, and maybe I might touch on what a volume imbalance is as well. So a fair value gap is a 3 candlestick pattern, and it is formed by the market moving away from a point rather quickly with a very big displacement. Okay, so I'm just going to go, can I turn off these indicators? Let me just clean the charts up a little bit. So I'm just going to go ahead and demonstrate what this candlestick pattern may look like, and then I will, alright, right here. So in normal cases, when the market price is delivering, you would get something that looks like this, where the wick of the first candlestick overlaps the wick of the third candlestick. This is what we would consider a balanced price range. A fair value gap is formed when the wick of the first candlestick and the wick of the third candlestick do not overlap, so they create a gap in between, which we can denote by maybe just doing that so you can see it better. Let me pick another one. Alright, so this area right here, from this to this, is what we would call a fair value gap. Okay, now these fair value gaps also do come with validation and invalidation zones. I will explain it right here. You would want to find the 50% of the fair value gap using a Fibonacci tool, which I'm going to do. So I know my 50% is right here. Where are we going? Alright. Then I can delete the Fibonacci tool. I don't need it anymore. So I know my 50% is right there. It's not perfect, but it will do for the illustration. Okay, so typically when we get a fair value gap, price likes to come back and rebalance the fair value gap. This can be done by either just wicking slightly above the third candle's wick and then continuing to the downside. Sometimes we could have a full wick all the way to the top and then continuing to the downside. Now what invalidates and validates the zone is the candle's body closes. Alright, so if this, because this is a bearish example, if we get a candlestick, right? Actually, can I draw one just for illustration's sake? So let me draw. The first example could be something like this, and the wick would be we would get a wick just pip right above the third candle's wick, like that, and then we could get price continuing to the downside. And then for invalidation and validation, what we would want to see is the candlestick could come into the fair value gap as well, but it must close below the 50%, also known as a mean threshold. So this is an example of a full fair value gap fill. So it would look something like that. For as long as the candle body stays below the 50% line, this is valid. The moment the candle body closes above this 50% fair value gap line, then we must invalidate it. This fair value gap will not hold. Okay, so I hope that was clear enough. Just a quick rundown of what I explained. To validate or invalidate a fair value gap, you want the candlestick that balances the fair value gap, which is this one here. You want it to close below the 50% of the fair value gap. Anything that closes above that 50% of the fair value gap, we shall invalidate that entire fair value gap. Okay, so I think I can delete that and that. Leave the 50%. A volume imbalance, on the other hand, is where you get the candlestick open of the first candlestick have a gap between it and the second candlestick, kind of like shown right here. And you would mark it something like, you would use the bodies, you would mark it like that. Okay, and then you would also mark this one like that. And price will come back and usually balance that gap as well, so we could get something like this, and the wick right above like that, balancing that volume imbalance. Okay, so I think I'm done explaining what a fair value gap is. I have demonstrated what a fair value gap looks like, and I've demonstrated what a volume imbalance looks like. I have also demonstrated what a balanced price range looks like. So I think maybe we could try and find chart examples of that. Have I turned on my candlesticks? Yes, I have. Alright, so I don't even have to go far. We have a fair value gap right here. So we can pick the wick of that candle there, draw it out like that. Then we can also pick the wick of this candle here, draw it out like that. And then this right here is your 50% line. I had this fair value gap marked up before when I was trading, so that's why I know this is my 50% line. And to validate this fair value gap, we must close above the 50% line. And as you can see, we're on the 1 hour. We closed below the 50% line over here. So this is an invalid fair value gap in my books, and I should expect price to continue down, pushing to the downside. Okay, where do we have another fair value gap? We have a gap here. Gaps can also look like this, and these usually get filled in. As you can see, we had a fill in right here. Where else do we have a fair value gap? We have one right here and right there. We did try closing above the 50% line, but we ended up closing below it, invalidating this fair value gap. Alright, so let me try and see if I can find one that is actually valid. These ones are usually found, let me try the 5-minute, the intraday time frames. Oh, I should have looked for these earlier to make this easy. Or maybe the 15-minute. And honestly, I have invented an indicator for this, so I'm not usually drawing out fair value gaps on the regular anymore. I just have the indicator do it. Okay, so I have one right here. So in between here, right there, we have a fair value gap. And right here, we also have a fair value gap. And if you look at this candlestick right here, it came right into the fair value gap and closed outside the fair value gap. So this is a valid fair value gap. So this is what we would want to be taking if we're looking at any form of entries. Then let me give you an example of a balanced range. I think I saw some on the daily time frame when I was analyzing EU. Okay, here we go. So right here, we draw it out like that. Then right here, we draw it like that. And this is your volume imbalance right here. And as you can see, we balanced it from these candles onto our right side. Okay, so I think that's all the information I had on fair value gaps. They are fairly simple. If you didn't understand it, remember to leave a comment down below and maybe I can try and explain it further or detail it a little bit more. But for now, this is all I had. And thank you for watching. Remember to like the video, subscribe to my channel, and I will see you in my next one. Hi, hello, it's me from the future. I just watched back the video I recorded and I noticed I made an error. So I said an example of a balanced price range and then proceeded to give you a volume imbalance. Let's just blame that on my ADHD because sometimes I think things way before I say them and I think I've done them already. So I'm sorry. But balanced price range example will be, well, it happens everywhere to be honest. This one here, this candle wick and this candle wick are overlapping, as you can see. This candle wick and that candle wick are overlapping, this and that overlapping, and that's what a balanced price range should look like. All right, then again, sorry for the error, just thought I should pop by and make a correction. But other than that, carry on.